Hey, it's Joe Crump. I got another email here. This one is from Todd. I don't have his location or his last name. What is good to research when looking for remote markets to hold property? What factors make a piece of property good to hang on to, make for good areas to hold, value versus rent, demographics, finding good management companies, other factors to consider? Well, you've hit the most important ones. First of all, if you're buying properties for the long term, for holding it, you're looking at rent to price ratio, lower prices with higher rents for a particular area. In Indiana here, I can buy properties for $40,000 or $50,000 that make me $900 a month in income, or $800 a month in income, depending on the neighborhood that they're in or how good a deal that I got. But let's say you've got a $50,000 property that makes you $800 a month in income. Is that better than a $100,000 property that makes you $1,000 a month in income, which you can also buy here in the same town? But the rent to price ratio is much more attractive on the $50,000 property. Now, the thing you have to be careful of, you have to find the sweet spot, because you can also buy properties that you can get for $20,000 that are in war zones that have rents of $600 or $650, and that would be better on paper than the $50,000 property as far as the numbers go. But the $50,000 property makes more sense because it's in a more stable area, and you're going to have a lower lower cost and a lower vacancy rate. And the most important part is you'll be able to find somebody who will manage it. It's very difficult to find a manager in war zones, so you have to be careful about that. You want to be in blue-collar areas if you want to get the highest price-to-rent ratio. Now, the next thing to look at is, and that's if you're buying cash properties and you're going to hold on to them. That's what I do for my portfolio. My IRA Roth portfolio is full of properties like this. We also buy subject-to properties, and these are long-term properties that don't have a lot of cash flow in them, and the goal with them is to break even. When you buy a property that says it rents for maybe $1,200 a month, and your costs on it, property, principal, interest, taxes, insurance plus property management, runs at about $1,000 a month, that's okay. Those are great long-term properties. You want to try to find one that's got fewer years left on the mortgage, but a lot of them that you'll find, they'll have 27 or 28 years left on the mortgage. That's okay. You'll be 70 or 80 or whatever when they finally pay off, but it's okay. The rents are going to go up, so your cash flow is going to increase over time because rents go up based on inflation, and your taxes will creep up as well. Your insurance might creep up as well, but the values will also creep up. So maybe you keep them for 10 years and the values jump up 20, 30, 40, 50%, and you turn around, sell them, you make a chunk of money, you convert them, you transfer them on a 1031 exchange, so like-kind exchange, so you don't have to pay taxes on the capital gains. You buy another property under market value and you do the same thing with that. But if you're buying a property on subject to, you don't have any money into the deal. So it's just about managing the property. And if you have a property manager who's managing it for you, you're in great shape. And if you sell it to a lease option buyer for full price, which is over what you paid for it, usually you can get 10% more on a lease option deal. So you raise the price, you take the lease option fee, so you take $5,000 or $10,000 out of the lease option. So you have that as income. And then let's say the people stay in there for a year or 2 years, and they make the payments for you during that time, and then it goes vacant if they don't exercise their option, and you sell it again, and you get another lease option fee, and you continue to get the income coming in from it. What I suggest is you take some of that lease option fee and you put it into an escrow so that when you do have a vacancy, you'll have some reserves to cover it. But a lot of people, once you have multiple properties, like if you have 10 of these, or you have 20 or 40 of these properties, and I've got lots of students who do, then you don't need to keep as much cash reserve. You just need, that maybe there's going to be 10% or 5% vacant at any particular time, so make sure you have enough reserves to cover 2 or 3 months of 10% of the properties that you have this way, so you can cover the mortgages and make sure that you do justice to the sellers that you purchased from. And worst case scenario, when you buy subject to, if you can't make the payments, you give it back to the seller. You give it back to them while it's still current. If you're going to fail, you're going to fail in a way that's not going to hurt them very much, and it's going to be no worse for them then than it would have been if they had not sold it to you in the first place. So that's the goal if you ever have to give a property back on a lease option. So when you're buying from these places, you want to look at the areas that have properties that fit the demographic that you like. Now, if you're buying subject to properties, you're going to keep them for the long term, you're probably not going to buy properties that are over $200,000, because when you start getting over $200,000, and there's a few places that you can do this, but if you start getting over $200,000, you're not going to have enough income from that property to pay the mortgage if it's financed up, which most of these subject twos are going to be financed up at 90% or 80% of their market value. So you're not going to have enough to do that, not going to have enough cash flow to do that. So it makes sense, if you're going to go after a subject to campaign, to do it in an area that maybe the average price is $100,000 or $125,000. Those are great places for subject to. There's also great to do them in rural areas where you've got properties that are $30,000 or $50,000 in a rural farming area, and you can get $600 a month rent for properties like that in rural areas, and you can buy them subject to, or you can buy them, a lot of people, they own them free and clear, and they'll sell them to you on terms on a land contract with no interest. So a $30,000 property, you pay it over 10 years, just divide 30,000 by 120, and that's your monthly payment, or whatever it is that makes sense for you. So you have enough cash flow. You make your payment, design your payment for these types of deals. You can tell them how much you'll pay, and you design it around how much cash flow you're going to have in order to pay these things off. But if you're not paying any interest, everything is going towards paying that off. So instead of doing a 15-year loan with interest, you can do a 7-year loan and pay it off at about the same rate. And then you own that property after 7 years, and all the income that comes in on that property is free and clear. And this is on cheaper properties, and we see this a lot in city properties and in rural areas as well. So there's a lot of ways to do this, and you're gonna base your demographics, you're gonna base where you're buying based on what you're trying to accomplish, because there's ways to make money in high-end markets too. And usually that's by flipping those properties. But if you're in a high-end market that you can get and control, and you know that that market is really hot, you got a 20% annual increase in that property, it might make sense to take that property subject to, get in control of it, don't have the mortgage in your name, don't have any money into the deal, and take that property and maintain it, make sure the mortgage is paid, make sure there's a tenant in it, wait a year, wait 2 years, turn around and sell it for 20% more than you bought it for. And if that's a $300,000 or $400,000 property, that could be, $40,000, $50,000, $80,000, $100,000 of profit that you can make it within just a couple of years. But the big risk to this, or the big thing to watch out for, is this is predicated upon the values going up, and you don't have any guarantee that the values are going to go up, and that you're going to be able to sell it for cash after that. So your exit strategy has less, has more risk to it, and less likelihood that you'll actually accomplish it. But if you do it the way I'm talking about with seller financing, your risk in it will be low. What happened during the boom in 2005, 6, and 7, before everything crashed, you look at places like South Florida, where the values were going up in Florida, they went up 47% in 2006. The values went up 47% in Florida, which meant that anybody who was buying a $400,000 property, suddenly it was worth $600,000 in 1 year after they bought it. But then it crashed, and they put money into those properties, and they bought these properties, they got in control of them, and they put $80,000 down, 20% down, they put a mortgage in their name, and then the values crashed, and they went from $600,000 down to $250,000. And now they would rent for $1,200 a month, but their payments were still up there in the $3,000 range. So they had these great big mortgages with negative cash flow, and the only way they could get out of it is by trashing their credit or waiting and having these big, huge negative cash flows. If they'd bought it subject to, or if they'd bought it on terms or on a land contract, they would never have had that problem. And if you remember, I don't know if you've read my story or know my story, but I went through that in California back in 1991. When there was a crash at that time. That crash was less than the 2007 crash. But when it hit me then, I lost all of my properties because I was mortgaged out, I was highly leveraged, I was making a lot of money. I had $17 million of business going at the time. But I lost it all because I didn't structure it properly. When it happened in 2007, I was pretty leveraged as well, but I was leveraged in a different way. Plus I had cash reserves, plus I had a lot of properties that were free and clear, so I didn't get damaged damaged nearly as badly. We lost a little bit of money because we had some vacancies during that time because people lost their job, but it didn't hurt me that badly. And I didn't really lose. I just didn't make as much as I'd hoped for. So hopefully that answers the question. Thanks.